Welcome back to the deep dive. I have to admit, the prep for today's session felt a little bit like doom scrolling.
Oh, I know that feeling.
You know that feeling when it's like 11:30 at night, you should be asleep, but instead you're on Zillow just looking at houses you can't afford in cities you don't even live in.
Oh, absolutely. It's the modern American pastime. It's real estate voyeurism.
It is.
It's almost a competitive sport at this point.
Exactly. But for most of us, it's not just voyeurism. It's anxiety. We are tackling a topic today that I think occupies about, 50% of our collective brain space.
At least.
We are talking about the housing market. And specifically, we are taking a hard, unflinching look at the concept of the housing bubble.
It is the specter haunting every homeowner and every hopeful buyer. It's the ghost at the banquet.
It really is. Because housing isn't just shelter anymore. Somewhere along the line, we developed this massive cultural narrative that housing is the safe investment.
Right. The one thing that always goes up.
It's the retirement plan. It's the legacy. For a huge chunk of the population, it is the single biggest financial asset they will ever own.
Which puts a tremendous amount of psychological and, financial pressure on that one asset.
Totally.
If your stock portfolio drops 10%, you're annoyed, maybe you skip a vacation. But if your house value drops 10% or worse, if you buy at the peak and it drops, you feel like your life is falling apart. You feel trapped.
Precisely. And the terrifying question that keeps people up at night, whether they just bought a place or are desperately trying to, is this. Is the price I'm paying actually real?
Is it tangible?
Is this value tangible? Or is it just hot air that's about to pop?
That is the multi-trillion-dollar question. And frankly, it's a question that economists, sociologists, and regular home buyers have been wrestling with for centuries. It's not a new anxiety.
So here is our mission for this deep dive. We're going to move beyond the scary headlines.
Yeah.
We are ignoring the clickbait that says crash imminent every single Tuesday. We have a massive stack of research here anchored by a really comprehensive breakdown from Wikipedia that aggregates work from Nobel laureates like Joseph Stiglitz, housing experts like Lind, Mayer, Shiller, and we're going to break down the mechanics of a bubble.
We're going to look under the hood. We want to understand the engine, not just the shiny paint job. We need to strip away the emotion and look at the gears turning underneath.
We want to equip you, the listener, with the tools to spot the difference between a market that is just expensive. Because sometimes things are just expensive, right?
Right.
You pay a lot for a Ferrari because it's a Ferrari, not because it's in a bubble.
Correct. High prices do not automatically equal a bubble. That is probably the most critical distinction we need to make right up front.
So we're going to find that line.
Yeah.
And we are going to try to answer the big one. Can we actually predict when the pop is coming?
That's a tall order. Economists are notoriously bad at predicting the future.
Yeah? Wasn't there an old joke about that?
There is. The old joke is that economists have predicted 9 of the last 5 recessions. But the data we have today regarding housing is actually quite fascinating when you strip away the panic.
Okay, so here is the roadmap for our journey today. First, we are going to define what a bubble actually is. And I learned in the prep for this that it is way more controversial than you might think.
It is.
There isn't just one definition. There's a bit of an academic brawl over it.
A very polite, very nerdy brawl, but a brawl nonetheless.
The best kind. Then, we're going to get into the checklists. These are the tools researchers use, and they range from hard math to checking what people are talking about at dinner parties to spot the warning signs.
From the quantitative to the qualitative.
Exactly. And finally, we are going to take a tour of history. We have actual numbers from the past 40 or 50 years of OECD data to see just how high the highs go and how low the lows crash.
And looking at that history is so vital. It reminds us that we aren't the first people to go through this, and we certainly won't be the last. The patterns repeat because, human nature repeats.
So let's unpack this. Let's start at the very beginning. If I asked you to define a housing bubble stripped down the elevator pitch, what are we looking at?
Okay, if you want the most basic fundamental concept, a housing bubble shares the same DNA as any asset bubble. It operates in 2 very distinct phases.
Few phases.
Phase 1 is the run-up. Prices increase dramatically, and I don't mean they just tick up with inflation or because the neighborhood got a new park. I mean a surge driven by speculation, investing, and frankly, frenzy.
Okay, so up goes the rocket.
Exactly. And then phase 2, the correction. Prices fall dramatically, the bubble bursts, and housing, in theory, becomes affordable again.
Oh.
But here's the kicker, and this is why we care so much about housing specifically.
What's that?
Housing bubbles affect the real economy much, much more than other assets do.
When you say real economy, you mean the grocery store, the car dealership, the jobs report,
Yeah.
the stuff that affects my day-to-day life.
Precisely. Compare it to the stock market. If say a tech stock crashes, it hurts the people who own that stock. Maybe a few venture capitalists lose their shirts. Maybe some day traders have a bad month. But housing bubbles are credit-fueled.
Ah,
They involve mortgages, they involve the entire banking system, and they involve a massive number of regular households.
right. If I buy a stock that crashes, I lose my initial investment, but I don't usually owe anyone more money unless I'm doing something fancy like trading on margin.
Right.
But with a house, I've signed a 30-year contract to pay back a specific amount of money, regardless of what the house is worth tomorrow.
Exactly. If your house value crashes, you might go underwater owing more than the house is actually worth. And even if you don't sell, you stop spending money.
You feel poorer.
You feel poorer. You stop renovating the kitchen. You stop going out to eat. You delay buying that new car. That's something called the wealth effect. And it is so much larger for housing than for other financial assets.
Why is that?
Because for most people, the house is their wealth. So when your house feels worth less, you feel poorer, and the whole economy can grind to a halt because of it.
It's like the house is the battery of the consumer economy, and when the bubble bursts, the battery just dies.
That is a very, very apt metaphor.
Okay, so that's the general vibe. We know it's big, we know it hurts. But let's get into the nitty-gritty of the definition, because you mentioned there is a debate here.
There is.
We have two heavyweights in the source material regarding the definition of a bubble, Joseph Stiglitz and H. Lind.
Yes. And this is essentially the battle between the why and the what. It's a philosophical divergence on how we should even view economic events.
The why versus the what. Let's start with Stiglitz. He's a Nobel Prize winner, wrote about this way back in 1990. What was his take on it?
So Joseph Stiglitz takes a very psychological and fundamental view. For him, a bubble is defined by the intent of the buyer.
The intent. Okay.
He argues that a bubble exists if the price is high today, only because investors believe it will be selling for even higher tomorrow.
So it's purely speculative. The asset itself doesn't even matter. It could be a house, it could be a fidget spinner, it could be a tulip bulb.
Exactly. He says you have a bubble when fundamental factors do not justify the price. The only justification is the belief in the future price rise. He's looking for that disconnect between sort of the utility of the thing and the price of the thing.
It's like buying a ticket to a concert, not because you want to see the band, but because you think a scalper will pay you double for it next week.
That is a perfect analogy. You don't care about the music, the utility of the ticket. You only care about the resale value. If the music or the shelter, in the case of a house, doesn't justify the price tag, Stiglitz says that is a bubble.
Okay.
It implies that people are buying just to pass the hot potato to someone else down the line.
The greater fool theory.
Exactly. I buy it for $100 because I think a greater fool will buy it from me for $200.
Okay, that makes a lot of intuitive sense. If I'm buying a shack for $1 million just because I think it'll be $2 million next year, that feels like a bubble. But then comes H. Lind in 2009, and he's essentially the anti-Stiglitz.
He is.
What's his problem with that definition?
Lind's problem is practical. He looks at Stiglitz's definition and says, "That's great philosophy, Joseph, but how on earth do we measure it?" He argues that the concept of fundamentals is way too vague to be useful in the real world. I mean, who decides what the fundamental value of a house in San Francisco or London is?
Right. Is it the sunshine? Is it the job market? Is it the fact that there's a cool coffee shop on the corner? How do you put a number on that?
You can't. It's subjective. It's messy. One person's overpriced shack is another person's green renovation project in a prime location. Lind argues that if we rely on fundamentals, we'll just never agree on when a bubble actually exists. We'll be arguing about it forever.
So if you can't measure the fundamentals, you can't prove it's a bubble until after it pops.
Exactly. Stiglitz's definition leaves you arguing about feelings and intentions. It's not empirical. So Lind proposes a definition based solely on price movement.
Just the data.
Just the data. He says, stop worrying about why the price is moving. Just look at the chart. His definition is simply, a bubble is a dramatic increase in real prices over a period of months or years, followed by an immediate dramatic fall.
He's saying, I don't care about your feelings or your psychology. Show me the geometry.
That's a great way to put it. Don't worry about the cause. Verify the existence by the shape of the data. If it looks like a mountain, a steep climb up and a steep fall down, it was a bubble. It's a retrospective, data-driven definition.
That seems a lot easier to measure. And speaking of measuring, the source material actually gives us some hard numbers from a couple of researchers, Aust and Rafelson, from 2017.
Yes.
And I love this because it finally puts a number on the word dramatic.
Yes.
We aren't just using adjectives anymore.
Yes, they tried to operationalize Lynn's definition. They created specific mathematical thresholds for what counts as a large bubble versus a small bubble.
So it's a binary check. Is it or isn't it?
Pretty much. It gives us a ruler to measure history with.
Okay, lay it on us. What is a large bubble in the eyes of an economist?
To qualify as a large bubble, you need real prices. And that's inflation-adjusted prices, mind you. So we aren't just looking at nominal dollars.
Important too.
A very important detail. Real prices have to rise at least 50% over a 5-year period. Or if it's a shorter, more intense boom, 35% over a 3-year period.
Let's pause on that. A 50% increase in 5 years after inflation. That is a massive jump.
It is.
If your house is worth $500,000, 5 years later it's $750,000 adjusted for inflation.
Yeah.
That is wealth creation literally out of thin air.
Correct. It's compounding at a rate that far, far outstrips wages or normal economic growth. It's an anomaly, but that's only half the definition.
Right, it has to pop.
It has to pop. So they define the fall as an immediate drop of at least 35%.
Oof, that is painful. That wipes out almost all the gains.
It does. It essentially resets the market, but it leaves a trail of bankruptcy and financial pain in its wake.
And what about a small bubble? What are the thresholds for that?
A small bubble is a rise of at least 35% over 5 years or 20% over 3 years, and that's followed by a fall of at least 20%.
I really appreciate that they put numbers to this. It gives us that measuring stick so we aren't just using vibes. It allows us to look at history objectively and say, okay, 2008 in the U.S. was a large bubble, but maybe, 1995 was just a blip.
It does, but it also highlights the tricky problem with Lynn's definition, which you pointed out earlier.
What's that?
You only know for sure it was a bubble after it has crashed.
Right. Until it crashes, it's just a dramatic rise. You're standing at the top of the mountain, but you don't know if you're about to fall off a cliff or just walk onto a plateau where prices stay high forever.
Exactly. And that brings us to the most critical part of our discussion today. How do we identify the bubble before the crash? We need to distinguish between something being just expensive or overpriced versus being in an actual bubble.
This is a distinction that I think gets completely lost in the media frenzy. Every time prices go up, someone screams, "Bubble!" It feels like crying wolf after a while.
It does. But as our expert sources note, overpricing is necessary for a bubble. You can't have a bubble without overpricing, but it is not sufficient.
Not sufficient.
You can have overpricing without a bubble.
Explain that. How can something be overpriced but not be a bubble? That seems contradictory.
Think of overpricing as a deviation from the equilibrium price. A fever is a good analogy here. A fever is a symptom.
Yeah.
You can have a fever because you just ran a marathon in the heat that's overpricing due to temporary supply and demand issues. Maybe a big factory opened in town and there aren't enough houses yet.
So prices go up.
Prices go up, that's a fever.
But that's rational, right? High demand, low supply, price goes up. That's Econ 101.
Exactly. That fever will break naturally as more houses are built. But a bubble is a specific disease that causes the fever. It's when the price goes up, not because of the new factory, but because everyone believes prices always go up.
So the fever becomes self-sustaining.
The fever becomes self-sustaining. The disease is the expectation, not the underlying reality.
That's a great way to put it. So to diagnose the disease, researchers first need to determine what the equilibrium price should be. How do they know what the body temperature is supposed to be in the first place?
Well, Christopher Mayer, back in 2011, surveyed the research and found 3 main approaches to finding this equilibrium. These are the 3 litmus tests economists use to see if the patient is sick.
Okay, let's walk through them. Method number 1.
The finance-based method. This treats a house exactly like a stock or a bond.
How does that work?
If you are valuing a company, a share of stock, you look at the discounted sum of its future dividends, right?
Right, the cash it's going to pay you. But houses don't pay me dividends. I pay it. I pay for the roof, the boiler, the property taxes.
Well, actually, in economic terms, it does pay you a dividend. The dividend is the rent you save by living there or the rent you could earn by leasing it out.
Okay.
Economists call this imputed rent. It's the value of the service the house provides you, which is shelter.
So the price of the house should theoretically equal the discounted value of all those future rent payments.
Exactly. And this gives us a really powerful tool. The price-to-rent ratio. This is your PE ratio for housing.
Price to earnings for a house.
Precisely. If house prices skyrocket, doubling, tripling, but rents in the same area stay flat, the finance-based method says, hey, this asset is getting overvalued relative to the cash flow it generates.
You're like a stock with a PE ratio of 1,000. It just doesn't make sense mathematically. At some point, you'd be better off renting the house next door and investing the difference.
Precisely. If the price-to-rent ratio gets way out of whack, the market is signaling a disconnect from reality. If it costs $5,000 a month to own but only $2,000 to rent the identical house next door, why would anyone buy?
The only reason they'd buy is if they think the price is going to keep rocketing up so they can sell it to that greater fool.
Exactly. You found the bubble. It's speculation.
Okay, that makes sense. What's method number 2?
The construction cost method. This one is really interesting because it relies on physical reality. The logic is simple. Why would a used house be worth drastically more than the cost to build a brand new one right next to it?
Right. If a 30-year-old house on the market costs $1 million, but I can buy a plot of land and build a replica for $500,000, the market is broken. Arbitrage should kick in.
Exactly. Competition from new construction should, in a rational market, drive the price of existing homes down to the cost of construction. If used houses are too expensive, developers will just build new ones until the price drops.
But there's a nuance here, isn't there? Something called the kinked supply curve.
Yes, I'm glad you brought that up. It was described by Glazer and Yurko in 2005, and it explains why crashes happen the way they do.
The kinked supply curve. It sounds like a bad dance move, but I have a feeling it's important.
It's very important. The theory is that supply is highly elastic, meaning it's flexible when prices are high. If prices are above construction costs, builders rush in. It's relatively easy to build more houses. You see cranes everywhere.
Put up the drywall, pour the concrete, expand the suburbs. Let's go.
But, and this is the critical part, when prices fall below construction costs, supply is inelastic. It is stuck.
Because houses are durable. They don't just disappear when the market goes down.
Precisely. You can't unbuild a house to reduce supply. You can't just delete it from the server like a failed crypto coin. So in a down market, you have all this inventory that won't go away.
So prices can shoot up, but they can't fall as easily.
Well, what it implies is that on the way down, the recovery is incredibly slow because that excess supply hangs over the market like a dark cloud for years.
That explains why the bust feels so heavy and just drags on and on. The houses are just sitting there waiting for buyers who don't exist.
And builders stop building completely because it costs more to build than to buy. So the market freezes. That is the kink in the supply curve.
Okay, that's a powerful concept. And the third method for finding that equilibrium price.
The affordability method. This is the one most listeners probably use intuitively when they're looking at Zillow at midnight. You compare prices to income.
The price-to-income ratio.
Right, or price to wage. The logic is undeniable. Ultimately, housing must be paid for by wages. If prices get too high relative to what people earn, they simply cannot consume the same level of housing services.
You hit a mathematical wall.
You hit a mathematical wall where people literally cannot get a loan to pay the mortgage.
So if the average person in a city makes $50,000 and the average house is $2 million, something has to break. It doesn't matter how much hype there is, the math just doesn't work.
Exactly. That is a clear sign of deviation from equilibrium. When you need 3 generations of income to buy a 1-bedroom apartment, you are very likely in a bubble. The fundamental utility of housing is clashing with the financialization of housing.
Okay, so those are the mathematical ways to spot if prices are out of whack. But markets are made of people, and people are. Well, they're emotional, they're weird, they get FOMO, they get jealous, they make bad decisions because their brother-in-law did something.
Which brings us to the entire behavioral side of things. It's arguably the more important part.
Yes. Section 3 of our dive, the vibe check. We're looking at Robert Shiller's checklist from 2010. Shiller is famous for predicting the 2008 crash. He literally wrote the book Irrational Exuberance.
He did.
And he didn't just look at spreadsheets, he looked at people. He looked at the culture.
He did. He identified the social contagion aspect of bubbles. He argues that a bubble is essentially a sociological phenomenon. It spreads like a virus. It's a narrative that takes hold of its society.
So he has a checklist of 7 signs. I want to walk through these, and I want you to tell me why each one matters. Sign number 1, sharp increases in the price.
This is the catalyst. The chart goes vertical. It creates the momentum that draws people in. You see the movement and it catches your eye. It's the initial spark that gets the fire going.
Okay, that makes sense. Sign number 2, great public excitement.
This is when housing stops being a utility, a place to sleep and eat, and becomes the main topic of conversation. This is the cocktail party indicator.
Right.
When everyone, regardless of their job, teachers, mechanics, doctors, people who have never looked at a financial statement in their lives, is talking about real estate prices at a barbecue.
Oh, I've been to those parties.
That's
Oh, did you see what the house down the street went for?
Exactly. When the conversation shifts from how are the kids to what's your Zestimate, Shiller says you should be watching out.
Which leads right into number 3 on his list, an accompanying media frenzy.
The news cycle feeds the beast. It creates a feedback loop. You see headlines about record prices every day. You see TV shows about house flipping proliferating. You see magazine covers about how to get rich in real estate.
It normalizes it.
It amplifies the signal and validates the obsession. It makes it feel like the whole world is participating. And you're missing out if you're not.
Okay, number 4 is really interesting. Stories of people earning a lot of money, causing envy.
The envy factor is so powerful. Shiller specifically points this out. We are competitive creatures. When you see your neighbor, who you know isn't smarter or harder working than you, make $100,000 in a year just by sitting in their living room because their house appreciated,
It drives you crazy.
it triggers a psychological need to participate. You feel like a sucker for working a 9-to-5 job while they get rich doing nothing.
You feel like you're losing by not playing the game.
Precisely. It challenges your sense of fairness. And the only way to resolve that internal conflict is to jump in and get your slice of the pie.
FOMO weaponized.
Okay.
Number 5, growing interest in the asset class among the general public.
This is when you see people who have no business being real estate investors becoming real estate investors. The classic dentist buying 5 condos in Miami scenario. When amateurs flood the market, it's usually a sign the top is near.
Why is that?
Because they are the greater fools we talked about. They're entering the market late, driven by the envy and the media hype, not by any sound financial analysis.
Okay, number 6 is my favorite because it sounds so dangerous. New era theories.
This is the most dangerous one of all. This is the intellectual justification for the madness. It's when people start inventing reasons why this time is different.
The old rules don't apply anymore.
Exactly. They'll say prices will never go down because land is scarce, or because of the new tech economy, or because demographics have changed forever. They invent a narrative to explain why price-to-rent ratios don't matter anymore.
It's the denial of gravity. It's people convincing themselves that the laws of economics have been repealed just for them, just this once.
It is the rationalization of the irrational. It soothes the anxiety of paying an insane price. You tell yourself, it's okay I'm overpaying because we are in a new era.
And finally, number 7 on Shiller's list, a decline in lending standards.
This is the fuel on the fire. When the banks start giving money to anyone with a pulse because they too believe the collateral, the house will never lose value.
It becomes suspiciously easy to get a loan.
Suspiciously easy. No income verification, no problem, no down payment. Sure, that's the financial system pouring gasoline on an already raging fire.
So Shiller's list is basically a guide to spotting social hysteria.
It is. It's about spotting when a market has detached from reality and is running on pure emotion and cheap credit. It's a qualitative assessment of the market's sanity.
Now, for the listener who really wants to look under the hood, the one who isn't satisfied with just the vibe or the general math, we have another layer.
Yes.
This comes from Lind, the same guy who gave us the anti-Stiglitz definition. He outlines some deep dive indicators that are much more technical.
These are excellent because they cut through the noise. They break down into 4 specific groups of warning signs. If Shiller measures the emotion, Lind measures the structural fragility of the market.
Let's hit group 1. Interest payments and income. What are we looking for here?
So we're looking at whether interest payments are eating up a larger and larger percentage of household income. But there is a crucial check here that I absolutely love.
What's that?
Lynn suggests asking this question. Would payments be increasing if we applied historical interest rates to today's prices?
Oh, that's smart. So it's the stress test. It spots if artificially low interest rates are masking the affordability problem.
Exactly. Let's say interest rates today are 2%, so the monthly payment on an $800,000 house looks affordable. You think, I can afford this.
Right.
But historical rates are closer to, say, 6%. If you apply that 6% rate to the current home prices and the payment suddenly becomes impossible, you are in a danger zone.
Because rates won't stay at 2% forever.
Right. It's a stress test for the entire market. If the market only functions at emergency low interest rates, it's not a healthy market. It's a bubble on life support, waiting for the Fed to pull the plug.
Okay, that's a great tool.
Sure.
Group 2 is buyer expectations and risk.
This goes back to the psychology. Do buyers expect prices to rise forever? Do they view housing as risk-free over a short horizon, like 3 to 5 years? But Lind also looks for a specific behavior he calls impatience.
Impatience, like people are rushing to close deals.
Yes, but also financial impatience. Are people buying at a younger age than they usually do? Are they buying more house than they actually need, stretching their budgets to the absolute limit?
Okay.
And crucially, are they amortizing less?
Meaning, are they paying off the principal of the loan or are they just paying the interest?
Correct. If you see a rise in buyers switching to interest-only loans or 40-year mortgages just to make the monthly payment fit, that is a massive red flag.
Why is it such a red flag?
It means they aren't buying the house to pay it off and own it free and clear someday. They are essentially renting money from the bank to hold the asset while it appreciates. They are betting entirely on capital gains, not on building equity through payments.
That is risky business. You're betting the farm that the value goes up before that loan comes due or the rate adjusts.
It's the definition of speculation.
Okay. Group 3 is bank behavior.
This one is counterintuitive. Normally, when prices are high, you'd think banks would be more cautious, right? The asset is expensive, so it's risky. If a stock shoots up, a margin lender might get nervous and ask for more collateral.
Right. You'd think they'd tighten up lending standards to protect themselves from a potential fall.
But in a bubble, you see the exact opposite. Banks increase their loan-to-value, or LTV, ratios. They get more liberal as prices rise.
They're willing to lend you more money against the same asset.
Yes. They are chasing market share. They have the same FOMO as the buyers. If you see banks competing to give the most reckless loans during a boom, that is a classic bubble sign. They're abandoning their own risk models.
And Group 4 is simple. Speculation.
Simply put, are buyers planning to sell quickly? The fix and flip mentality. Housing is naturally a long-term asset. It has high transaction costs, realtor fees, taxes, closing costs.
It's not meant to be day traded.
Not at all. If a large share of the market is treating it like they're day trading stocks, the stability is gone. The market becomes a casino.
The source also mentions a few other statistical indicators that I think are worth rapid firing through. First one, vacancy rates.
High prices plus high vacancy rates equals danger. This was the story in parts of Spain and more recently China. If prices are going up but nobody's actually living in the houses, it means supply exceeds real organic demand. You have purely speculative ghost towns.
Next one, demography.
Is there actually a net inflow of people to the area? If a city's population is shrinking but its housing prices are doubling, the math doesn't work. Who's going to live in all these expensive homes?
It seems like there are so many flashing red lights if you just know where to look.
There are. The problem is when the party is going and the punch bowl is full, no one wants to look at the warning lights. We are all too busy dancing.
Well, let's look at what happens when the music stops and the lights go out. We're moving into Section 5, Historical Case Studies.
Yes.
The source material has this incredible table from Alston Raffingselson covering OECD countries from 1970 to 2015.
This is where the rubber meets the road. We can talk theory all day, but these are the actual scars on the economy. These are the large and small bubbles we defined earlier, playing out in the real world.
Let's talk about the big ones, the large bubbles. The champion, the undisputed heavyweight of the dataset seems to be Ireland, peaking in 2007.
Oh, Ireland is the textbook example of a massive boom and a truly devastating bust. It was the Celtic Tiger economy. And just look at the numbers. The rise lasted 56 quarters.
56 quarters. That's 14 years.
14 years of straight winning. An entire generation grew up thinking real estate only goes up.
And how much did prices go up in that time?
They increased by a staggering 235.6%.
Wait, say that again?
235%.
That is insane. That's just, I can't even wrap my head around that.
It is. Imagine buying a house for 100,000 euros and watching it go to 335,000 without doing a single thing. You feel like a genius. You feel invincible. But then, the fall.
How bad was it?
Prices collapsed by 53.6%.
They lost more than half their value.
Yes. And you have to consider the leverage. If you bought near the top with a 10% down payment and the value of your asset drops 50%, you are completely wiped out. You owe the bank vastly more than the house is worth.
That's national insolvency.
It was. It bankrupted the Irish banking system and required a massive international bailout.
That is wealth destruction on a scale that just ruins a generation. What about Finland? I see they had a peak back in 1989.
Finland is interesting because it was almost perfectly symmetrical. Prices rose about 68% over 15 quarters and then fell about 50% over the next 26 quarters. It was a classic mountain shape, a quick up and a slightly slower, but just as brutal, down.
It shows that what goes up doesn't just come down.
Sometimes it comes down just as hard.
And the Netherlands in the late 70s.
A huge rise, almost 139% increase, and then a 52% fall. You start to see a pattern here. When these large bubbles pop, they tend to cut prices roughly in half. It's a reversion to the mean, but it's a violent one.
We have to talk about the USA, the 2006 peak, the great financial crisis.
Of course. The rise was 92.9% over roughly a decade, from the mid-90s to 2006, and the fall was 39.6%.
You know, compared to Ireland's 53% drop, the U.S. drop of around 40% sounds, well, I won't say better, but less catastrophic on paper.
Percentage-wise, yes, but context is everything. Because the U.S. economy is the engine of the world, and because that housing debt was packaged into these incredibly complex financial instruments, mortgage-backed securities.
So things from The Big Short.
The very same.
Yeah.
And they were sold globally. So that 40% drop in U.S. housing prices triggered a global financial crisis that we're still feeling the effects of today. It shows that even a smaller crash in percentage terms can be systemic if the debt is toxic enough.
Now let's look at the small bubbles category, and specifically Japan.
Japan is fascinating. Everyone talks about the Japanese asset bubble of the late 80s, and it was massive. But in terms of housing-specific data in this study, the rise was about 80% into the 1990 peak.
That qualifies as a bubble. But the fall is what stands out to me in the data, the duration.
Yes. Look at the duration of the fall. It lasted 74 quarters.
74 quarters. That's almost 19 years.
19 years of sliding prices. The aggregate drop was around 50%, similar to what Finland experienced. But instead of a sudden crash over a few years, it was a slow, grinding bleed that lasted for 2 decades.
That sounds almost worse. A sudden crash is painful, but a generational stagnation.
It changes the psychology of a nation. If house prices fall for 20 consecutive years, nobody views housing as an investment anymore. It becomes a liability. It changes how people save, how they retire, how they view wealth for their entire lives.
And then you have a country like Denmark, peaking in 2006.
A massive rise there, 180%, but the fall was only about 28, 29%.
So it didn't really correct.
It didn't. Prices stayed elevated relative to where they started. That's an important nuance. Not every bubble bursts all the way back to zero. Sometimes it just corrects and then stabilizes at a new, higher plateau.
So buying in a bubble isn't guaranteed ruin, but it's a massive, massive gamble. One thing that was pointed out in the notes is the duration analysis.
Yes. Generally speaking, the rise phase lasts longer than the fall phase. For the USA, the rise was 38 quarters, the fall was 23. Bubbles take time to inflate. It takes years to build that confidence and supply that easy credit.
But fear is fast.
But fear strikes quickly. When the sentiment turns, the elevator cable snaps.
Escalator up, elevator down.
In many cases, yes. Though as Japan shows us, the elevator can sometimes get stuck between floors and just slowly, painfully slide down for 2 decades.
This brings us to section 6. We need to put all of this in a broader perspective. Because when you're in a bubble, it feels unique. You think, we've invented a new economy, the internet changed everything. But history says otherwise.
Bubbles are not new. They are not a modern invention. The Wikipedia source lists them going back centuries. This is a recurring feature of human economics. We love to get excited about things and bid them up to insane prices.
I was surprised to see the 1810s Alabama real estate bubble on the list.
Slaps, yes. Alabama fever, they called it. It shows that as long as there has been land to speculate on, Americans have been speculating.
What drove that one?
It was driven by high cotton prices after the War of 1812. Everyone thought cotton would stay high forever, so the price of land you could grow cotton on skyrocketed. Then the price of cotton crashed in a panic, and the land market collapsed. Same story, different century.
And the 1830s Chicago bubble?
That was driven by urbanization. Everyone was betting on the future of the city as a major hub. People were buying lots in Chicago without ever having seen them, just based on a map.
The 1920s Florida land boom.
Oh, that's the classic. Selling swampland in Florida to people in New York who had never seen it, that was pure mania. Promoters were literally hiring buses to drive people down from the north to these lavish parties to sell them land.
And then we see a shift in the 1990s and 2000s to these global bubbles. It mentions the Baltic states, China, Romania, Poland.
It went from being a localized phenomenon like Florida or Chicago to a globalized, credit-fueled contagion. As finance became global, bubbles became global. The same cheap money could flow from New York to Dublin to Madrid in an instant.
I want to touch on the comparison to non-housing bubbles, just for context. We've all heard of tulip mania in the 1630s, or the dot-com bubble in the late 90s. How is a housing bubble different?
The key difference is utility. You cannot live inside a tulip bulb.
True.
You can't shelter your family in a website or a shareofpets.com. Housing has immense, undeniable utility. You need it to survive.
Okay.
And this makes housing bubbles stickier. People fight to keep their homes. They don't just sell them at a loss the way they dump a crashing stock. This is why that kink supply curve we talked about matters so much. The asset is essential, and it's durable. That makes the pain of the crash much more visceral and long-lasting for society.
It's not just losing points on a screen in your brokerage account, it's losing your roof. It rips entire communities apart.
Exactly. It has a human cost that's just on a different scale.
So we've covered the definitions, the math, the vibes, and the history. Let's bring this all together into the outro and synthesize this for the listener.
Let's do it.
If we have to summarize what we've learned, a bubble is a specific economic event. It's when prices decouple from the fundamentals, things like rents and incomes.
And it is fueled by a toxic cocktail of cheap credit and human psychology.
And the aha moment for me throughout all this research is always the new era theory. The single most dangerous indicator is the belief that the rules have changed. When you hear people saying prices only go up, that is the siren song of the bubble.
It is. Gravity always wins in the end.
So for the listener, the learner, what is the practical application here? You're thinking of buying a house or you own one and you're nervous. What should you do with this information?
The main takeaway is, don't just look at the price tag, look at the context, look at rents. That's the finance method. Is it significantly cheaper to rent the same house? If yes, be careful. That gap matters, and historically, it tends to close.
And look at construct.
Is there a massive supply of new homes coming online? Are there cranes everywhere in your city? Remember the supply curve. If supply floods the market, prices will soften.
Look at your neighbors.
Yes. Use Shiller's checklist. Are they buying out of envy? Is the dinner party chatter at a fever pitch? Are people panic buying houses they haven't even seen?
And look at the bank.
This might be the most important one. If the bank is offering you money too easily, be suspicious. If they are letting you borrow 100% of the value, or offering interest-only terms because they know you can't afford the real payment, run.
Don't walk.
Run! They are setting you up to fail.
It's about being a critical thinker in a market that can sometimes feel like it's full of sheep. Don't let the FOMO drive the bus.
Precisely. Knowledge is your best defense against the hysteria. Do the math. Check the vibe.
I want to leave everyone with a final provocative thought, something that jumped out at me from the source list. In the section on modern bubbles, it mentions cryptocurrency bubbles and AI bubbles.
Yes, the information age section.
If bubbles are driven by human psychology, this innate belief that we can get rich quick and that this time is different, have we actually learned anything from the housing crashes of the past? Or is the wealth effect, that feeling of getting rich for free, just too addictive to quit? Are we just moving the bubble from houses to coins to algorithms?
That is the multi-trillion-dollar question, isn't it? The asset changes, but human nature, that seems to stay exactly the same. We love the ride-up far too much to worry about the inevitable fall.
On that cheery note, thank you for diving deep with us. Go check your price-to-rent ratios, everyone. We'll catch you on the next one.
Stay grounded.